Well, hello, welcome to my studio here in fabulous Las Vegas. This is Dean Tenney. We've been working our way through an explication of the FINRA Series 7 content outline. We're currently in function 3. We haven't been doing this in order. As you can see here, this is 3.1. I will put in the playlist in order. There's a separate playlist for the explication of the Series 7 FINRA content outline. Section 3 is 73% of your exam, 91 questions. So lots of questions. I highly recommend you print the PDF from the FINRA website and use it as an intellectual inventory, both as we talk through the explication of the content outline and then as an intellectual inventory on your own when you're studying. I would have it close by and see if you can put check marks. I intellectually own this, or I don't intellectually own this, because by test time, you should intellectually own most of these items. All right, so let's get started. Remember, no substitute for lecture, but just to give you an overview of what you're going to be able to get tested on. All right, so knowledge of 3.1. This is all the stuff that is in here you're held accountable for. Customer-specific factors that generally affect the selection of securities. So, we always start with investment profile of the customer. We do a personal balance sheet. We find out about their time horizon, their investment objectives, what are their liquidity needs. When we do that data gathering, usually before we open the account, but it informs our, decisions on suitability, what would be suitable and what would clearly be unsuitable, given their investment objectives and these items. Portfolio account analysis and its application to security selection. This gets tested over and over again, but diversification, you're going to get tested on non-systematic risk. I try and put this in different colors. I sometimes forget, but I'm trying to make the distinction between what I'm adding to the content outline and what's FINRA's content outline. But guaranteed to get a question about non-systematic risk, also known as selection risk. There were 10 equally suitable ideas. You picked one of the 10. The others did fine. The one you picked went under. And the easiest way to avoid selection risk test question is diversification. And the easiest way for most people to diversify is in a mutual fund. So you're certainly going to get tested on that. Asset allocations, concentration, volatility. We have a measurement of volatility, test question, of a stock or bonds, a stock or funds, or mutual funds volatility is compared to the market. As compared to the market is known as beta. That's a test question. As compared to the market is beta. So beta 1 would mean market goes up 10%, the stock or the fund should go up 1%. Beta 2, it should go up or down twice as fast as the market. And then alpha, I don't think you'll see alpha on your Series 7, but alpha is the return in excess of beta. Now in year 66, they'll go in a little more detail on that kind of stuff, a little more in depth on what's called modern portfolio theory. Volatility, potential tax ramifications. Watching your securities go up, the capital gains tax is a transaction-based tax, and the easiest way not to pay it is not to transact, right? So, realized, unrealized gains aren't taxable, but if you sell the securities, they certainly are. So you're tested on a general understanding of tax ramifications. As I mentioned, I wouldn't worry about alpha, and I wouldn't worry about capital asset pricing model either on Series 7. If you come back for a Series 6, or excuse me, 66, not 6. Oh my goodness, that would be freaking out our Series 6s. On 66, they get a little more into, this kind of stuff. And the capital asset pricing model describes the relationship between systematic risk and expected return. Yeah, and that's one of the underpinnings of what we call modern portfolio theory. So again, I wouldn't worry about that on your Series 7. I would certainly worry about that on your 66. Delivery of annual report. So you're going to get a 10K. That's the annual report. And the 10K has the financial statements. Whoop. The issuer, that's what we mean by publicly held company. It's a reporting company. It reports to a reporting public company, that's what the test assumes we're talking about, reports to the SEC, its market center, New York or NASDAQ or whatever it happens to be, Pink's OTC market, its market center, and its shareholders. And the 10K is the annual report, and that 10K is going to have a balance sheet in it. It's going to have an income statement, and it's going to have a statement of cash flow. That's what we call financial statements. That's also going to be, besides the 10K, the same thing for the 10Qs. There'll be 3 10Qs they'll file. And the 10Qs are not audited. We'll take the company's word for those quarterly statements. But the 10K is audited. Delivery annual reports and corporate notice of corporate actions. For example, at the end of each quarter, the board's going to get together and the board's going to decide based on our net income or lack thereof. We have an income statement. Top line is revenue. Bottom line is hopefully black in earnings, net income. So we've taken care of everything else. And then we decide how much we're going to retain and how much we might decide to declare as a dividend. So the board would decide whether we're going to declare a dividend. Once they declare it, it becomes a current liability of the corporation. The board might decide to split the stock. Tesla did a 5-for-1 split. Apple did a 4-for-1 split. The board might decide to do that. They might decide to make a tender to the existing shareholders for whatever, to buy back their stock, to retire odd lots. An odd lot, I wouldn't worry about odd lots, except to know that an odd lot, the normal unit delivery in securities is a round lot, which is 100 shares. And so an odd lot is something less than that. Fundamental analysis of the statements, of the financial statements. So say you're a fundamentalist does not mean you're a member of the religious right. Now, as we've been going through these explications, I've been telling you that there are lecture support behind each of these explications. I'm trying to bring these explications in about a study block time. To me, a study block is 45 minutes, an hour and a half. So I'm assuming when you're studying that you're carving up your study effort into what I call blocks, study blocks. And, you might be doing a practice final or reading or watching videos, whatever the case you may do. So, most of the time I've said that the explication that I'm trying to bring in at about an hour, maybe give or take, study block time is not a substitute for the actual lectures where we actually spend, an hour on things I'm going through in 5 minutes. Now, this is the exception. A lot of people have said, Dan, do you have anything on the YouTube channel about balance sheets? And I said, I do not. I do not have it on there because I don't think it's a big deal in terms of making your mark. So at the end of this explication, I will be able to say, yes, I do have something on balance sheets on the YouTube channel. You can find it in Critical Function 3.1, where we talk a little bit about balance sheets in a way that I think is sufficient to make your mark on Series 7. So I told you what the financial statements were. I said the financial statements are going to be a balance sheet, a picture in time of the company, a picture in time as of December 31st or March 31st or whatever it happens to be, June 31st. And we said it's going to have a income statement and it's going to have a statement of cash flow. And there'll be some footnotes, and footnotes can be very, very important because there might be some material information in there we should know. Now, we should know about assets on the balance sheet. Now, there's 2 types of assets that you're held accountable for on the balance sheet. Current assets, things we plan on turning to cash, or things we will turn to cash within 12 months. And then we have long-term assets or fixed assets, which is the opposite, right? Things we're not planning on turning to cash within 12 months. As I said, by the way, this is testable on 2 levels. It's testable, what we're doing now, fundamental analysis. To say you're a fundamentalist does not mean you're a member of the religious right, but it also is testable in terms of knowing, being able to do this for your customer or prospect. Let me sit down and do a personal balance sheet with you. Now, on the liability side of the balance sheet, same thing. We have current liabilities, things that need to be paid within 12 months. And we have long-term liabilities. Again, in your personal situation, long-term liabilities would be the mortgage, the car payments, those things that extend over a year, right? So long-term liabilities. Capital, cash flow. Cash flow is the real money. So cash flow doesn't include, cash flow. I don't know if it's helpful, but I think of it as the real money that comes in or out. It's very easy to fake a balance sheet, very easy to fake an income statement. It's very hard, much more difficult to fake a statement of cash flow, because I'm asking you now about the cash coming in and cash going out. And that doesn't depend on, how you're recognizing revenue or how you're recognizing expenses and whether you're capitalizing. Almost every stock fraud that gets caught, it's because of discrepancy in the cash flow, where, the accounting firm says, let me see the bank statements that support that money came into this corporation and that money went out of that corporation. For us, the major point or major difference between the income statement and cash flow is cash flow does not include depreciation, because depreciation is a non-cash expense. Does not include. So a couple ways to think about it. We're not adding it in or we take it back out. Depreciation is a non-cash expense. As a corporation, we don't get to use assets for free. We got to charge the asset for its use, because sooner or later we're going to have to replace it. And so that's a big thing. I think you're going to get more tests on that as it relates to direct participation programs than you are going to be tested on that as it relates to what we're talking about now. But I'll leave it for you. So then we're going to have net income. And we divide the net income by the number of shares outstanding. I'm not going to make you do this on the test. On the test, this will be a given number, the number of shares outstanding, and we get what's called earnings per share. Now, that is given information on the test, but remember, then the board is going to decide how much of that they're going to actually either retain as earnings or how much of that they're going to distribute to shareholders as a dividend, right? So that's the idea here about this earnings per share. Book value is testable. And if they ask this on the test, it'll be the theoretical liquidation value of the corporation. Again, I'm not going to make you crunch it. It is. And you would come up with book value. The answer set would have par value, market value, and you would come up with book value. We don't assume we're going to do that. It means we sell off all the assets, we pay off all the liabilities. What would be left? Shareholders' equity. So on the balance sheet, when we take assets minus liabilities, that's why it balances, because the other side is going to be equity. So if we have $100 million on the asset side and we have $60 million in liabilities, we would have $40 million in shareholder equity. That's both the paid in capital and the retained earnings we left in the corporation. So we talked about depreciation, depletion. And again, I think you'd see more of this as it relates to partnerships than as it relates to corporations, but for natural wasting resource, so we're Exxon or we're Chevron or we're Newmont Mining. I don't know how much oil is down there, but this I do know. If I pump a barrel of oil and I sell it, I have one less barrel down there, right? So, or if I have an ounce of gold and I, mine the ounce of gold and I sell it, I got one less. So the depletion allowance is to give us a tax incentive to go find a replacement barrel or another ounce of gold. It's a tax incentive. So depletion. Goodwill is again, an intangible asset. That could be patents. It could be, brand. I mean, what are the golden arches worth? I don't know, but I can tell you this. It may not be the best food, but I know the golden arches, I know what I'm going to get. Dean will never eat a Hydrox cookie. It's Oreos or nothing, right? So what's that brand worth? There's some brand value perhaps, but it's again, an intangible asset. Balance sheet. I haven't had anybody in years tell me they had to do this, but how do we value our inventory? One thing we should know is that when we're doing things with inventory, we're either going to use, again, this isn't testable, but is testable is what's called quick assets. And quick assets don't include the inventory. I'll talk about that in a little bit. For right now, I haven't had anybody tell me they've seen this in years, but when we sell an item today, are we selling in our inventory, the last thing that came in is the first thing we're selling? Or is it the first thing that came into inventory, the first thing we're selling? So LIFO would give us lower margins. Let me get a different color. Because the assumption is that, if we're selling the first things that, it says last in, first out, it's the assumption is we paid more for that. And so we're going to have lower margin, lower profit margin. Again, I haven't had anybody tell me they've seen this in a long, long time. If we're using FIFO, first in, first out, that means the inventory, we have a lower cost typically, and that would give us a higher profit margin. Haven't had anybody tell me in years they've seen that. We talked about the income statement. We said that's another piece or another part of the financial statements. Earning before interest and taxes, before we pay interest on the bonds and before we pay taxes. I use this one a lot here recently, right? Toys R Us filed Chapter 7, Sears filed Chapter 7. Chapter 7 is a complete liquidation of the business. And, the toy business is hard. I mean, Toys R Us trying to sell toys and in competition with Amazon and Walmart is certainly tough. I'd be the first to agree that. But they were still making earnings there. But then they had billions of dollars on debt on their balance sheet. And then they have to pay the interest on that. And, forensic accounting, we could make a pretty good case that really killed them was the debt, and not so much that they couldn't sell toys, or Sears case couldn't sell, their products. That gives us net profit, earnings before interest, taxes, and depreciation is called EBITDA, and principal tools to measure. Now, this next area is testable. And so working capital, I would definitely know. Working capital is current assets minus current liabilities. On a bad draw, they might even ask you, what is the effect on working capital based on what a board decides to do? For example, if a board declares a dividend, that becomes a current liability, and that would cause working capital to decrease. Again, the risk of bankruptcy is if we have too much of the stuff. So here, these are liquidity ratios. Our next one, as you see here, is the current ratio. The current ratio is the current assets divided by the current liabilities. Here it says our next one is quick assets. So quick assets is the current assets. We don't want to have to sell our inventory to pay our bills because we won't get the price we want. We won't get the margin. So quick assets equals the current assets minus the inventory, because we don't want to have to sell our inventory to pay our bills. And that's called quick assets. Now, the reason that's important is because if you don't know that, you can't do the acid test or quick ratio. The acid test or quick ratio is the quick assets divided by the current liabilities. I actually do some of this math in other lectures where we actually do this. I do this in the equity lecture, I believe. I show these things to you. Yeah, I also do it in my lecture called Series 7 Math. I go through this. I also have some practice questions where I go through this. So I do show you that math in other areas. I'm not going to put the numbers to this because it would become kind of a mess. But anyways, that's our last one there. And then these other ratios, this next one we have is about solvency, not liquidity. So, not being liquid is different than not being solvent. And so bond ratio, the debt to equity ratio, is we're going to take the debt. I'll just make up a number. Let's say we had $40 million in long-term debt. This one's kind of hard to do without showing you some numbers. So I'm just making up some numbers. 40 million. And long-term debt. And let's say we had 60 million in shareholder equity. Now, this part is testable. This part is testable. We capitalize. The capitalization of a corporation consists of perhaps two components. Equity and debt. If we're conservative, maybe we don't issue any debt. We just finance our corporation with equity. Kind of hard to go bankrupt if we don't owe anybody any money, right? So equity and debt would be, the things we capitalize. And in my example that I just made up, we had, let me fix that. And let me put some dollars here. And we have 60 million here. And so here we have $100 million. So what we're going to do is we're going to take the 40 million in bond money, long-term debt, and we're going to divide by our total cap, which is our total capitalization, which is 100 million. And when we do that, we find out that we have debt to equity of total debt. Debt to equity is kind of a misnomer because it's actually debt to total capitalization. And when we do this, we find out that 40 cents of every dollar actually belongs to the bondholders. And again, that may or may not threaten our solvency. Efficient use of the assets. I haven't anybody told me about it. They've seen inventory turnover in years. Cash flow, I would know, does not count the depreciation. I haven't anybody in years tell me they had to do profit margin or net profit or asset coverage. By the way, just to tell you, the study materials, the lectures and the explications are supplemental to study materials, but Dean is under no obligation because I tell you, the lectures are supplemental. If it's like a buffet, you don't like something, don't put it on your tray. But one of the reasons the study materials go into depth in this is because if it is in the FINRA test specifications, the content outline, they are allowed to test on it. And that means that, literally every study provider, study a vendor, whether it's, Kaplan or Past Perfect or Knopman or, STC, is going to literally go through every item on this and write entire chapters on it. Now, that doesn't necessarily mean it's something that you're going to see on your exam. So we're trying to stay really test focused. I told you I would expect a question about book value per share. There's no draw in which you're not going to have to do PE ratio. So maybe I tell you, it says here, PE ratio, where earnings per share is given, but we're going to take the price. Maybe I say it's 48 and the earnings is, I'll just make it up, current market price is $48 per share. And EPS, given information, is 4. What we're asking is how long would it take me to get back in earnings what I just spent? So I just literally take my calculator, 48 divide by 4, and I find out the PE ratio is 12. By the way, the vast majority of the Series 7 is division. So if you can't decide what to do, hit the divide key and you'll be right almost every time. Dividend and payout ratio. So in our example, we had earnings per share of 4. Let me get a different color here. EPS is 4. And the board's going to decide based on that earnings, again, how much we want to declare as a dividend. We might declare no dividend. We might say, I think as a board member, I say, I think we should leave that in the corporation so that we can use it to build the business, pay our bills. So I don't think we should pay any of that. Maybe somebody else says, well, I think we should distribute a certain portion of that as a dividend. These are the boards meets every quarter and makes these decisions. You don't have a right to a dividend unless it's declared. And maybe I come up with as a board member, I say, what I think we should do? Why don't we have a dividend payout ratio of 50%? That seems pretty reasonable. We'll give the shareholders half of that money. So that means the dividend here would be $2. I just made that up. Now, the way you would get that on the test, right, is the dividend payout ratio. You would take the dividend and you take dividend of $2, divide by $4, and you tell me the dividend payout ratio is 50%. Now, the other thing you might have to do on the test is identify a company as either being a mature, stable corporation or perhaps a corporation early in its life stage based on its dividend payout ratio, because we associate a higher dividend payout ratio with companies that are generating excess capital. And we wouldn't expect like Zoom, for example, to pay us a dividend. We would expect them to take whatever money they have and reinvest it in the business. You're definitely going to have to do current yield. Now be careful on current yield because, they might give you the quarterly dividend. So maybe I say the quarterly dividend is 50 cents. And then you got to say, well, wait a minute, I to do current yield, I got to have the annual dividend. So, I got to times that by 4. And then I find out that the annual dividend, I'm not, not every test is going to be jerky, but they might. I'm just saying. So don't be looking for tricks, but the annual dividend, if I take the 4, now I got my back in business. I got the $2 as my annual dividend. And then I divide it by what it costs me. So in our example, current yield is always what it pays you divided by what it costs you. In this case, it's going to be the annual dividend divided by the current market price. CMP means current market price. So in our example earlier, the current market price was 48. So I'm going to take $2, the dividend. I'm going to divide by $48 per share. And that would give me the current yield. Let me get my calculator. And let's see. So $2 divided by 48. I get a current yield of a little over 4%, 4.1, 4.2. Rounding on the test, by the way, would not make a distinction in your answer. All right, so let's see. We are in the middle of explicating 3.2. This came in about 30 minutes. I don't want to push the envelope. So you can basically see that we'll, next time we get together for the explication, we'll be doing 3.2 equity securities. That'll be our next explication. And we're getting close to having this function 3 done. So let's just go back here and remind you where we're at in this explication. We are at, let's see, what is that? We're working our way through this thing. And, I said that we're going to do it all. We're almost into function 4. But by way of reminder, here's where we're at presently. So we're working our way through 73% of the exam, 91 questions. We haven't done equity. We haven't done corporate bonds. I don't believe we've done governments, but we're getting pretty close to getting into function 4 and almost being done with the explication. I put the explication in a separate playlist, and so I'm hoping you find it there. Remember, we always do live Q&A on the Premiere, so I'll put this on the Premiere. And during the Premiere, you don't have to, you can, if you would want to do the live chat Q&A, you could ask questions about this lecture when it premieres during the Premiere, and then you can any other questions you may have during the Premiere. So I'll see you at the Premiere if I don't see you at some other Premiere. And remember, you have any questions about the explications, go ahead and just put it in the comment box. Make sure you tell people about the channel. Like, share. I'm pretty good at returning comments. If you have any comments or questions, put them in the comment box on the YouTube channel, and I'm pretty good at getting back to you pretty quickly. All right. Thank you.